Welcome to This Week in Impact, where we bring you 3 of the most interesting impact investing and sustainable finance stories of the week, as covered by ImpactAlpha. I'm Brian Walsh. It's Thursday, September 5th. I'm joined today by ImpactAlpha editor David Bank. We'll discuss innovative policy ideas to mobilize private financing for the ownership economy, how the U.S. government is mobilizing African capital for African infrastructure investments, and are corporate leaders hurting their shareholders by bowing to political pressure and abandoning DEI? That's all coming up on This Week in Impact. Hi, David. We're officially in back-to-school season. How are you doing?
I'm fine, Brian. I can't believe the summer is over.
Yeah, but now it's the best time of year. It's my favorite season. Fall is upon us.
Yeah, and that means the Fall Impact Conference season has begun.
Indeed. But first up, it's the ownership economy, stupid. David, you covered a new report this week laying out innovative policy ideas to increase ownership. Whether it's helping workers get stakes in the companies that employ them, residents get equity in the homes that they live in, or helping more low-income people build their balance sheets with retirement accounts. David, to start us off, why is increasing ownership an important issue?
Brian, wages have slightly outpaced inflation in recent months, and there's been pretty decent wage growth in recent years after kind of decades of stagnation, but that's never going to get to the vast gulf in income inequality and racial wealth gaps. And so the notion is that ownership of assets that appreciate and that have historically appreciated, at a pretty good clip, if you certainly if you take a long enough time horizon, is the way to get folks to have generational wealth and to be able to buy a home, put their kids in college, save for their retirement. So people have known home ownership as a pathway to the middle class for a long time, and obviously retirement accounts are important. The new thing, the new kid on the block, or maybe the old thing that's new again, is employee ownership and helping workers get a stake in the companies they work for. And the moment is now because of what people are calling the silver tsunami of retiring baby boomer business owners who, for both their own economic reasons and also their legacy, sometimes want to sell their companies to the employees that have helped build it. And part of that is then helping them finance that or helping those deals get financed. And so that's part of what this policy brief was about.
Yeah, you mentioned this policy brief. It's coming out of a new nonprofit called the Ownership Capital Lab, and they have this new ownership economy policy brief that details a number of practical reforms to legislation and to other government programs. Can you walk us through what are some of these proposed reforms?
Yeah, the Ownership Capital Lab is a new project from Allison Lingain, who we've known from Project Equity, which does have one of these funds that helps finance employee ownership conversions. And now she's working at a kind of level of market building and trying to mobilize capital through both not just fund creation, but also policy and advocacy and kind of networking. And so she brought together some folks. They actually all happen to be Ashoka Fellows, as Allison is, and they put their heads together of what kinds of things might mobilize that kind of capital. It's a little bit of a grab bag, or it seems like that at first glance, because it's changes it to the Community Reinvestment Act and the Small Business Administration and new markets tax credits and opportunity zones. But what I think is new here is grouping it all under this kind of umbrella of the ownership economy. And then in that regard, they're also quite, sort of practical and probably largely non-controversial tweaks to regulations that would free up some capital.
And this falls under the category of movement towards pre-distribution rather than redistribution, right?
Well, we love that because, as we said in the story, it kind of dodges some hot button issues, so it's not about, you can say what you want about taxing the billionaires, but that's still redistribution. And if you cut people in, for ownership stakes in their homes, in their businesses, and then obviously in the stock market through things like the retirement accounts, they get to ride up together. So you're not actually taking any wealth away from anybody, which, again, people can have different takes on that. But it's much more palatable to say, hey, let's all get rich together.
All right, well, let's take a look at some of these, though. So they addressed one with employee ownership by making some changes to opportunity zones. Can you tell us about how opportunity zones work now and how they're proposing they could work better in the future?
Well, opportunity zones, which came out of the 2017 Trump era tax cut bill, but which had arguably been one of the largest kind of community development initiatives of recent decades, is up for some reforms in any event. And what the folks in this report have suggested is that tweaks get made that both help small businesses, broadly speaking, get more financing under opportunity zones. Most of those deals have been like real estate deals, so get like operating businesses to be able to draw down both debt and equity, and then more specifically to have ways in which those that small business financing can be used for these employee ownership transitions. So sort of again, relatively minor tweaks and something that I think could use a little refresh. People have sometimes criticized opportunity zones for either gentrification or for sort of real estate projects that might have gotten built anyway, and so the notion that it would help kind of small businesses and job creation is going to be sort of popular, I think, for lots of folks.
So I also see that they have proposed, expanding the CRA, the Community Reinvestment Act. So what would that proposal do?
Well, yeah, that's also another bill that's up for renewal and for reform in any event. And the proposal here is that there's much of the lending is not banks anymore. It's credit unions and mortgage companies and insurance companies, and that's now something like 75% of financial assets. So having CRA-like requirements for reinvestment back into the communities where those companies do business would dramatically expand the amount of capital being channeled from those institutions, just as the CRA has done for banks. So banks make investments, for example, in community development financial institutions that do lending in low-income neighborhoods as a way to fulfill their CRA requirements. That's been a big source of capital for those kinds of lenders. And if you had more financial institutions covered under such regulations, then you would be driving, even more capital.
Now, DAFs, or donor advised funds, have become a big business. What are some of the proposals about how those could be more effectively leveraged for the ownership economy?
Yeah, I think we're going to see a lot more about DAFs coming up. It's gotten to be sort of a hot button issue. There's something like $230 billion sitting in these donor advised funds, much of it, some of it at community foundations, but much of it at the Fidelity, Schwabs, and Vanguards of the world. And unlike private foundations, which at least have a minimal payout requirement, so a private foundation has to distribute 5% of its assets each year to charities or nonprofits in their programmatic areas. These donor advised funds have no such requirement. So in a lot of the money, it's already gotten the tax break for the donor, and it's just sitting there in these accounts. So there's a big push now to get that money out the door. And then there's an additional push that these folks have proposed, which again we've been on top of for a while, about allowing the corpus, the actual principal of those accounts, to be used for impact investing. So there's a number of outfits now that are helping investors put the DAF corpus to work, just like foundations are starting to put their endowments to work. Sort of the corpus of the DAF is essentially the endowment, and getting that into impact companies. So then you'd have not just the payout of the accounts, but the actual principal of the accounts. And again, it's another way that there's lots of capital available, and small tweaks could drive it towards impact.
All right, now, so these are all interesting proposals, but they also, require legislation to actually get implemented. So what about these proposals make them more attractive to kind of a bipartisan accomplishment?
Well, one of the things that makes them attractive is that they could be bipartisan, which is a vanishing species, it seems. So the notion that that it's hard work and entrepreneurship and people wanting to step up and invest and be part of the build the American dream. I mean, that's something that both parties are trying to kind of grab hold of. So hopefully there'll be kind of a race to the top in this case of ways to make relatively minor tweaks and free lots of capital for ownership.
All right, well, you can read this full story about the ownership economy and more on ImpactAlpha.com. There's a link to the article in our show notes. But let's take a quick break. When we come back, mobilizing African institutional capital for investments in African infrastructure. In a guest post this week, Natalie Alm and Topeka Chawla of USAID, the U.S. government's International Development Agency, wrote about lessons learned from the past 7 years of the USAID's INVEST initiative, which works to tap into local African-based institutional investors, like pension funds and insurance companies, to invest in infrastructure investments in Africa. This is a big issue because Africa faces an estimated $100 billion annual infrastructure financing gap. And among the barriers to plugging this gap are private investors' risk perceptions, lack of awareness of investable opportunities, and lack of sizable deals that fit investors' portfolio requirements. Now, the authors stress that this was not a so-called catalytic or concessional capital. It was all commercially driven. David, how did the USAID Invest initiative operate?
Well, USAID Invest, people should realize, is the part of USAID that's trying to mobilize private capital. So people think of USAID as kind of foreign aid. USAID Invest provides kind of technical assistance and management know-how. And what's interesting in this report they put out is the ability to leverage local capital, local institutional capital, African capital for African infrastructure, as it were. And there's something like $1.8 trillion in these, African institutional investors, pension funds and insurance companies. For starters, they investigate a vanishingly small amount in sort of infrastructure and alternative assets, something like 3%, rather than stocks and bonds. But also, much of their investments in the broad market are not, local in Africa. So this, set of initiatives was get local African pension funds and insurers to find ways to invest more in local African infrastructure. And they that means bringing people together, like you said, bringing enough deals together so the check sizes can be large enough for these pension funds to be able to manage the transactions, bringing the investors together so that the pool of capital is large enough to fund these infrastructure things. Kind of the blocking and tackling to make these deals investable for local investors. And as you said, interestingly, not always, or at least not in large part, with the kind of catalytic kind of credit enhancements and things, but on a largely commercial basis.
Now, what has some of the impact that they've seen so far of the 7 years of this initiative?
Well, let's just say it's still, early days. But I think, as proof of concept, perhaps there's something interesting here. So they've mobilized something like, $774 million from institutional investors. Much of that from domestic sources, and much of that going to infrastructure. In Nigeria, for example, they pulled together a bond issue, I think about $291 million to finance like 200 infrastructure projects. And many of them were, small kind of sanitation, hygiene, so-called WASH projects. They would never have been able to raise institutional money for, individually, but together, they made a package that could be made investable. Similarly, they brought together Kenyan pension funds and helped attract members to that. Built a pipeline of deals. Again, made enough money available to finance those deals, and I think got something like $115 million done in 3 different infrastructure deals. So again, small compared to the total need, but maybe path breaking in the sense of getting folks to work together who often don't.
The other benefit of local investors investing in African infrastructure is that they can more easily invest in the local currencies where they operate. So tell us why that's a benefit.
Well, that's huge, actually, because that's one of the biggest risks is you lend in dollars and you're getting paid back in something else, and that something else might be devalued before you get paid back. So currency risk is probably tops the list of things that international investors worry about. Now, if you have local investors making those loans in local currencies and getting paid back in local currencies, the risk is much less.
All right, and what are the broader implications here for driving even more financing to Africa and other areas of the global South?
Well, again, I mean, the main thing is, that there's lots of capital available in these countries. I mean, people may have a sort of outdated notion that everybody is flat broke, but between the pension funds, the insurance companies, other sources of local private capital, there is local ability to drive local development and meet local needs, and making those things investable, making them palatable, making them fit the investment policies of those institutions, could really unlock vast sums of capital, much more than has happened so far.
All right. Well, once again, you can read this full guest post on impactalpha.com, and we have a link in our show notes. But let's take a quick break for now. When we come back, we'll answer the question, are corporate leaders hurting their shareholders by bowing to political pressure and abandoning DEI? In a guest post this week, Andrew Behar, CEO of As You Sow, and Meredith Benton, principal and founder of Whistle Stop Capital, argued that the string of recent corporate announcements backtracking their DEI commitments run counter to their fiduciary duty. David, can you lay out the case they made here?
Yeah, Andy Behar of As You Sow has been contributing an occasional column to Impact Alpha in recent months, called Fiduciary Future. And in this one, they make an interesting case, which is that if it seems to be the case, the data shows diverse workforces, diverse leadership leads to corporate outperformance on share prices, if nothing else. Then reversing the policies that have created such diversity might be considered to be hurting shareholder value. And in particular, they target companies that had strong or announced diversity programs who have recently reversed themselves or scaled back those policies. And as you said, there has been a political attack on DEI, diversity, equity, and inclusion, that has caused many corporate leaders to kind of pull in their horns a bit. And the question then is, well, if they're bowing to political pressure to back away from DEI, are they actually hurting shareholder value? And that would be a kind of reverse on the way that many of these have gotten framed. So we thought it was a kind of provocative and interesting way to frame up the issue.
Now, they also brought the receipts, right? They did an analysis of their financial performance. And what should we make of that?
Well, yeah, it actually goes back to a kind of watershed McKinsey analysis from 2015 that underscored all the ways that diversity supports financial profits and company outperformance. And then last year, As You Sow and Whistle Stop conducted their own study and kind of underscored the same results. And in fact, I guess the takeaway was the more white males a company has, the more likely it is to underperform financially.
So with the companies backtracking on their DEI commitments, does that actually set up a potential legal challenge for these companies?
So I'm not a lawyer, as they say, but there have been a number of announcements in recent months of companies that are backtracking. So Ford Motors last week kind of diminished its public commitment to DEI, and would no longer participate in certain surveys about this. Lowe's, Harley Davidson, John Deere, Tractor Supply Company have all made statements that go back at least some part from earlier pledges or commitments that they had made. So the argument is they had earlier made these pledges to diversity, that diversity leads to outperformance or good performance. Now they're going back on that. Does that conversely mean that they're going to have poor performance? And is that something that shareholders might be concerned about, as you said, legally?
Right. So it's the backtracking where investors might be able to make the case that, hey, they made buy, sell, or hold decisions based on their previous statements in support of DEI initiatives. And now they are changing those commitments and seemingly doing so not necessarily for fiduciary duty reasons, but because of political and other pressure.
Yeah, and it neatly kind of turns the attack back in on itself, because the attack had always been, these woke corporations are hurting shareholder value by adopting these DEI and ESG sort of positions. And in fact, now the argument's being made, these backtracking corporations are hurting shareholder values by bowing to political pressure on the other side. So it's a nifty parallelism.
So we'll see if there is indeed this backlash to the DEI backlash has some legs.
Yeah, Brian, and then I'm sure there'll be a backlash to the backlash to the backlash.
Indeed, and you'll hear it all here on Impact Alpha. That's going to do it for this week in Impact. You can read all three of these stories and much more on ImpactAlpha.com. Check out the links to each post in our show notes. Thank you so much, David.
Thank you, Brian, as always.
And thank you all for listening. If you liked what you heard, please subscribe to this podcast wherever you listen and share it with a friend or colleague. If you want to help out, be sure to leave us a 5-star rating, and if you're up for it, give us a review on Apple Podcasts. It really helps other people discover the show. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. For more exclusive stories about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.